Give me my money back. That was not a gift.
Gave me money for my down payment in 2018.
So Tamar Braxton was saying she gave her sister a loan for the down payment on her home. And her sister was saying it was not a loan. It was in fact a gift. Now, both of these things are permissible through the IRS. There are specific rules that follow in order to receive a loan or receive a gift. And I want to talk about what some of those rules look like for the purposes of a gift. So let's break this down. Was it really a gift or was it a loan? I don't know, but we're about to find out. Stay tuned. At the end, I'll have some information for you if you want to give someone a loan or a gift or anything like that for something that they're doing to make sure you stay out of trouble. I am Shanta Thomas, an enrolled agent, tax strategist, and the go-to for turning IRS problems into IRS wins. Before we jump in, I want to remind you to make sure you subscribe to help me continue to do this. All right, now let's jump into it. Let's break all of that down and talk about IRS and a mortgage lender and what that looks like when it comes to actually purchasing a home with someone's gift. So let's look at the IRS rules first, and we're gonna look at this from Tamar's perspective. So Tamar was saying that it was in fact a loan, right? So here's the things you need to know from an IRS's perspective. If you are giving someone a gift, there is an annual exclusion for gifts of $19,000 per person. So if I am giving someone a gift, I can give you a gift of $19,000. Now, what if you're married? I can give you a gift of $19,000 and I can give your spouse a separate gift of $19,000 to be under that annual gift exclusion. If I am married and I'm giving a gift, I can give you $19,000 and my spouse can give you $19,000 as well. So you actually could receive $38,000. Now, if you go over that limit, it just means you have to file a form 709. It's not necessarily taxable, but you do have to report it because in a lifetime, you have about $14 million that you can give in gifts before it becomes taxable, before taxes due. So in a situation like this, the giver, who is Tamar, is responsible for any sort of gift tax. So these are all important things to remember. The key point here is if Tamar didn't file a form 709 and she expected repayment, from her perspective, this is not a gift, it would be a loan. Tamar said, I gave it to her. The IRS would ask, was there any expectation to get it back? And if that was yes, then it's not a gift. Now, what are the lender rules? Because that's IRS tax stuff, right? But that doesn't mean those are the same rules for lenders. So lenders do allow you actually to take on a gift if you are needing that for a down payment. In fact, they sometimes will say, do you have a parent? Do you have a sibling? Do you have somebody who can give you a gift? In this particular case, you have to follow the lender's rules. So when someone gives you money for a home down payment, lenders have strict gift rules. The buyer, who was Towanda, would have needed a gift letter saying that there was no repayment expected, proof of funds transfer, bank statements, wire receipts to show that the money was received, and an eligible donor. The money must come from a relative or someone without a financial interest in the sale. The reason why this matters is from the lender's perspective. Lenders use this to confirm that it's not a secret loan because loans will increase your debt ratio. So if you've ever went to purchase a house, they look at your income to debt ratio, and those ratios have to be within a certain range in order to get the house. So someone can give you a gift, but they cannot give you a loan to purchase. So if Towanda didn't have a gift letter, the lender might see this is borrowed money, not a gift, which could have affected her loan approval. The other part of this is Tamar said there was a bankruptcy later filed, and she was listed as one of the creditors.
Said I will pay you back the next day, and then you listed me as a creditor.
Oh my God.
So in order to be listed as a creditor, that means it has to be a loan. If you give a gift, that's not considered a creditor. So if Towanda put her in that bankruptcy, and she didn't deny it, so she put her in that bankruptcy to say that this in fact was a creditor, that means it in fact was a loan and never was a gift. At the end of the day, this is more set up the way it was set up as a loan, but maybe as one of those secret loans that lenders don't like because you can't really take on a loan as the down payment. Neither one follows loan or gift. In order for Towanda to have gotten the house, more than likely it had to be a gift. But everything else says that it was a loan. But again, there's no paperwork. The fact that Towanda reportedly listed Tamar as a creditor during bankruptcy makes it legally a loan and not a gift. So you can't list your sister as a creditor if she gifted you the money. That's like saying someone gave you a birthday check and you owe them back. That doesn't work. So what should have happened? If it was a gift, Tamar should have filed that Form 709. Towanda should have had a gift letter for the mortgage. Both should have kept documentation to show no repayment was expected. If it was a loan, they should have had a written promissory note, even if that's between family. The note should have also said the amount that was loaned, the interest rate, because if it's a loan, there has to be repayment with interest, which is important. Payment terms, due dates, all that stuff. In the IRS world, if it's not written, it didn't happen. So unfortunately, because there was no paperwork for gift, then it is being treated as a loan. And when the bankruptcy went through and she listed Tamar as a creditor, that loan is now gone, wiped out. That can cause some family drama, similar to what's happening right now. So what is it that we can learn from all of this? Family money really don't mix well. I mean, I think we've heard this over and over again, but one of the things you got to realize is family money really do not mix well. Anytime you give or receive a large sum of money, whether for a home, a business, bills, make sure you get it in writing. And if you're someone who gives that money to someone else, definitely make sure you get it in writing. Otherwise, you're probably not going to see that money back. You're going to be upset. I'm going to give you 7 tips to keep this from happening to you in the future. Always document your transfer. Write a gift letter or a loan agreement. If it's a gift, make sure you file that Form 709 if you give over $19,000 in a year. If it's a loan, include repayment terms, even if those terms are flexible. Never mix friendship and finances without clarity. Now, understand I didn't say never do it. I just said make sure there's clarity around it. And if it's for a mortgage, tell your lender up front so that it protects everybody in the situation. Make sure that they know that it is a gift because it cannot typically be a loan. All of this matters. The IRS doesn't care about your feelings or your forms or anything else. They just say, show me the money, show me the documentation. In this Braxton case, from a tax and lending perspective, that was a loan, not a gift. Despite initially what it was supposed to be, it was a loan. Tamar didn't document it as a gift, and Towanda treated it like a debt. Lesson learned, family or not, money always needs the proper paperwork. So if you want to avoid IRS drama like this, make sure that you subscribe because we keep it real about family and finances and taxes every week. But also make sure that if you have questions, you click on the link to grab our pamphlet that highlights what you need to know about tax debts that are due, that are owed, and how you can get assistance. And if you have any tax issues that you need assistance with, go ahead and schedule a call. We would love to talk to you. All right. I hope you have an amazing day, and I will see you in my next lesson.